Let me tell you something that happened in 2026 that most people completely missed. Not because the news wasn't there, not because the information was hidden, but because most people are too busy watching stock tickers and listening to talking heads to notice when the actual architecture of the global financial system gets quietly, permanently, and irreversibly rewired. I've been in this business for over 40 years. I broke the Bank of England with George Soros in 1992. I ran Dasan Capital for 30 years without a single losing year, and I'm telling you right now with the same conviction I had when I shorted the British pound, that what banks just did in 2026 is one of the most significant and underreported shifts in the history of modern finance, and almost nobody noticed. Here's what happened. On July 18, 2025, President Trump signed into law a piece of legislation called the GIMUS Act, the Guiding and Establishing National Innovation for Us Stablecoins Act. What happened in 2026? Passed the Senate 68-30. It passed the House 307-122, but partisan, overwhelming. And while the crypto Twitter crowd was busy celebrating, and while mainstream financial media was too distracted by Fed rate speculation and Magnificent Seven earnings to pay attention, every major bank on Wall Street sat in a boardroom and quietly started rewriting their entire business model. JP Morgan, Citigroup, Bank of America, Wells Fargo, the institutions that have defined American banking for over a century just fundamentally changed the rules of how money moves, and the average person walking into their local branch has no idea. Let me back up and explain what a stable coin actually is, because I know most people hear that word and think crypto bros and meme coins. Forget all of that. Strip away the noise. A stable coin is a digital dollar. It is a privately issued digital asset pegged one-to-one to the US dollar backed by liquid reserves designed to move on blockchain rails. It doesn't sleep on weekends. It doesn't close for holidays. It settles in seconds, not days. It crosses borders without a correspondent bank eating 3% in fees. It processes transactions at a fraction of the cost of Visa, MasterCard, or WFT. And in 2024 alone, stablecoins processed over $27 trillion in transaction volume. That's more than Visa and MasterCard combined. Let that number sit with you for a moment. More than Visa and MasterCard combined. And most Americans couldn't tell you what a stablecoin is. That's the gap between what's happening in the financial system and what people actually know. That gap is where fortunes are made and lost. Now, here's where it gets really interesting. And this is the part that I believe will define the next decade of Genius Act explained finance. The GEIS Act didn't just regulate stable coins. It created an on-ramp for the largest banks in the world to issue their own digital dollars. Before this law, there was genuine legal ambiguity about whether a federally insured bank could issue a stable coin. The banking regulatory framework didn't have a clear answer. Risk and compliance departments at every major institution were essentially saying, "We can't greenlight this product because we don't know how it gets classified." The GEIS Act resolved that ambiguity permanently. It carved stablecoins out of securities law. It carved them out of commodities law. It handed jurisdiction directly to banking regulators. And in doing so, it told JP Morgan, Citigroup, Bank of America, and every other FDI-insured institution on the planet, you are now officially allowed to issue your own digital dollar through a subsidiary. The gate just opened, and trust me, when the gate opens on a market this large, the institutions don't walk through it, they sprint. Within months of the law being signed, the FDI approved a proposed rule on December 16, 2025 that would allow FDI-supervised banks to issue payment stablecoins through subsidiaries. The OC followed with its own proposed rulemaking on February 25, 2026. Both agencies are racing toward a July 2026 deadline to finalize regulations. The effective date for the full law kicks in no later than January 2027. What this means in plain language is that by the end of this year, we will have a fully operational federal framework for bank-issued digital dollars. Every major American bank is currently filing applications. The infrastructure is being built right now today while you are watching this video in the back offices and technology departments of institutions that collectively hold tens of trillions of dollars in assets, and the banks are not doing this because they want to. Let me be very clear about that. JP Morgan's Jamie Dimon, a man who has called Bitcoin a fraud, and spent years dismissing crypto as a speculative bubble, sat on an earnings call in July 2025 and said, and I'm paraphrasing, because the man couldn't have been more uncomfortable saying it, that JP Morgan, what is a stablecoin, is going to be involved in both deposit coins and stablecoins because they have no choice. I think they're real, he said. Notice he didn't say he loved them. Notice he didn't say he believed in them. He said they're real. The way you'd say a threat is real. Citigroup CEO Jane Fraser told analysts that the bank is looking at the issuance of a city stablecoin. Bank of America's Brian Moynihan confirmed his institution would get involved. These are not enthusiastic technology visionaries. These are survivors who have watched what happened when Kodak ignored digital cameras, when Blockbuster ignored streaming, when taxi companies ignored Uber. They are not going to make that mistake. They are moving because the alternative is extinction. Here's what's driving that urgency. And this is the number that should make every person watching this video pay very close attention. A Treasury Department study, cited by both JP Morgan and Bank of America executives, concluded that banks could lose up to $6.6 trillion in deposits if stable coins were allowed to offer yield at scale. $6.6 trillion. That is not a rounding error. That is not a minor competitive adjustment. That is a potential collapse of the deposit base that the entire American lending system is built on. Think about how banks make money. They take your deposit at 0.5%, they lend it out at 6, 7, 8% on mortgages and business loans. The spread between those two numbers is how the banking system funds the American economy. Now, imagine that crypto platforms can offer 4 to 8% annual yield on stablecoin holdings, while your Chase savings account pays 0.5%. If you are a rational person, and most people with money are rational, you move your savings. And if even a fraction of American depositors make that move, the liquidity that banks use to make loans disappears. Citigroup's own research projects, stable coin supply growing to somewhere between $500 billion and $3.7 trillion by 2030, displacing up to $908 billion in bank deposits in the process. The banking industry has spent $56.7 million lobbying against stablecoin yield provisions. That is not the behavior of an industry why banks are panicking that is confident. That is the behavior of an industry that is terrified. But here is the brutal irony. And this is the part of the story I find genuinely fascinating from a macro perspective. The very same banks that are lobbying to kill stablecoin yield are simultaneously building stablecoin infrastructure at an extraordinary pace. JP Morgan has already launched JPMD, a deposit token running on the Base blockchain network available to institutional clients. Citigroup has been testing tokenized deposits and running blockchain-based dollar transfers between its New York, London, and Hong Kong offices. BNY Mellon launched digital asset custody services. JP Morgan built its ONX blockchain payments network. They are building the rails of the new financial system with one hand while trying to protect the old system with the other. That is not hypocrisy. That is the rational behavior of institutions caught between two competing imperatives: survive the transition and control how the transition happens. And this brings me to the man whose perspective I want to spend the second half of this video really digging into, because I think he sees something that most investors are completely missing. I've made my career by spotting where capital is going before the crowd figures it out. I don't follow consensus. I've never followed consensus. Consensus is the noise. The signal is what the data tells you before the narrative catches up. And right now, in March 2026, the data is telling me something very specific about the future of money. In a Morgan Stanley interview released this March, I said that stablecoins will serve as the backbone of the global payment system within the next 10 to 15 years. Not a portion of the market, not a niche product for early adopters, the entire global payment system. When I say something like that, I say it based on evidence, not enthusiasm. Let me walk you through why the evidence points exactly there. The stablecoin market just crossed $315 billion in total capitalization. 2 years ago, it was roughly $135 billion. That is more than a doubling in 2 years. Transaction volume in 2024 crossed to $27 trillion. Volume in 2025 was over $33 trillion. That is a $6.6 trillion threat, 22% year-over-year increase in on-chain transaction volume. MasterCard has built a crypto partner program with 87 companies covering every layer of a modern payment stack. Blockchain rails including Solana, Polygon, and Cosmos custody providers like Fireblocks, BitGo, and Anchorage digital exchanges including Binance, Gemini, and crypto calming infrastructure, including Cross, Riverbank, WebBank, and Sophie. This is not a marketing initiative. This is a complete rebuild of the back and settlement layer of global payments. Western Union and MoneyGram, the companies that have dominated cross-border remittances for decades, have already moved to integrate stablecoin infrastructure into their platforms. Amazon and Google are actively exploring stablecoin integration. Walmart is exploring it. Apple is exploring it. The same companies that process most of what Americans spend their money on are building on ramps to a payment system where stablecoins are the settlement layer. Now, I want to be very precise about something here because precision matters in finance. I am not saying banks are going away. I am not saying the dollar is dying next year. I am a Ronald Reagan old-school economist. I believe in markets. I believe in the dollar. When someone recently asked me to describe the U.S. economy in one word, I said strong. The dollar is the cleanest dirty shirt in the room. But the reserve currency status of the dollar is not guaranteed forever, and I doubt it holds its current dominance in 50 years. The question is not whether the dollar survives. The question is what form the dollar takes, who controls the infrastructure that moves it, and who captures the economic value of that infrastructure. Right now, companies like Circle with what JP Morgan and Citi are doing, USDC, and Tether with USDT control that infrastructure. The Guinea Act is the banking system's attempt to take that infrastructure back. Whether they succeed is the most interesting strategic question in finance today. Here is what I think most investors are getting wrong. They are watching the crypto price action. They are watching Bitcoin and thinking about whether to buy the dip. They are distracted by the noise. The real story is not what any asset is priced at today. The real story is the plumbing. The real story is the pipes that money flows through. I've always said the most important question you can ask about any investment is not what does this thing earn today, but what does the world look like in 5 years, and is this positioned to capture that world? When I look at the global payment infrastructure being built right now, the answer becomes very clear. Every major corporation, every major bank, every major government payment system, every major tech company is building on or migrating toward blockchain-based settlement with stable coins as the unit of exchange. The consumer experience won't change. You'll still tap your card. You'll still use your phone. But underneath that familiar experience, the settlement layer, the part that actually moves money between institutions across borders in real time, is being upgraded, and the institutions that control that settlement layer will capture enormous economic value. Let me give you the global picture here because I think a lot of American investors have a very US-centric view of this story, and that is a mistake. The European Union's MiCA regulation established a comprehensive regulatory framework for stablecoins across the EU. Japan has enacted stablecoin legislation. Hong Kong enacted its Druckenmiller's prediction-owned stablecoin ordinance in August 2025, with the first batch of licenses expected in early 2026. Singapore has been building its regulatory framework. The United Kingdom's Financial Conduct Authority is actively consulting on a tailored framework. South Korea, Brazil, the UAE, the list goes on. This is not an American phenomenon. This is a global financial infrastructure. Rebuild happening simultaneously on every continent. The countries and institutions that move fastest to establish the regulatory frameworks and the technical infrastructure will control the settlement layer of 21st century global commerce. The countries that move slowly will be importing other people's financial rails and paying for the privilege. Now, let me bring this back to what it means for you, because I know that's what you actually want to know. What does this mean for your money? What does it mean for how you think about your bank deposits, your savings, your investments? The first thing I want you to understand is that this transition does not happen overnight. And the people who make money on transitions are not the people who jump in the day they hear about it. The people who make money on transitions are the people who understand the structural direction early, position accordingly, and have the patience to let the thesis play out. The GIMU-S Act takes full effect no earlier than late 2026 and likely in early 2027. The implementation rules are still being written. The regulatory framework is still being finalized. The bank applications are still being reviewed. We are in the infrastructure construction phase of this transition, not the adoption phase. And the infrastructure construction phase is always where the best opportunities exist because the crowd is not paying attention yet. The second thing I want you to understand is the deposit yield story, because this is the piece that directly affects your personal finances, global adoption, EU, Asia, US, in the near term. Right now, the average American savings account pays around 0.5% annually. Right now, platforms offering stablecoin yield are paying 4 to 8% on dollar-pegged digital assets. That spread is not sustainable. Either the banks win the political battle and stablecoin yield gets restricted, in which case rates stay suppressed and banks maintain their deposit base, or the crypto industry wins, which, based on Trump's own public statements, calling bank opposition to stablecoin yield unacceptable appears increasingly likely. In that scenario, banks either have to raise their deposit rates dramatically to compete, or they start losing deposits at a scale that forces a fundamental restructuring of how they operate. I am not telling you which scenario plays out. I am telling you that you should understand the stakes and make decisions about where you keep your cash accordingly. The third thing I want you to understand is about the dollar itself, because this is ultimately what all of this is pointing toward. Stablecoins are dollar-denominated. USDT is a dollar. USDC is a dollar. The bank-issued stablecoins coming in 2026 and 2027 will be dollars. The irony of the entire crypto story is that the single largest consequence of blockchain technology might turn out to be a massive global expansion of dollar usage. Every person in every country in the world can now hold and spend digital dollars without a US bank account. Every business in every emerging market can now settle transactions in digital dollars without correspondent banking relationships. The dollar's reach, already unprecedented in human history, is about to expand further through the very technology that its critics claimed would destroy it. What this means for you. That is the kind of paradox that separates great investors from average ones. The obvious narrative, crypto kills the dollar, turns out to be wrong. The actual story, crypto amplifies the dollar, is hiding in plain sight. I'll close with this. I've watched 50 years of financial history. I've seen the birth of derivatives markets. I've seen the rise and fall of entire currencies. I've seen the invention of index funds, the rise of algorithmic trading, the transformation of bond markets. Every single time a major transition happened in the architecture of the global financial system, most people missed it. Not because they were unintelligent, not because they lacked access to information, but because they were looking at the wrong things. They were watching the price action instead of the plumbing. They were watching the narrative instead of the data. They were listening to the loudest voices instead of the quietest signals. The quiet signal in 2026 is banks just change the rules. The Guinea Use Act has signed law. The FDI proposed rule is on the table. The OC Rule M is underway. JP Morgan is building JPMD. Citigroup is launching a Citi stablecoin. Bank of America is in consortium discussions. Western Union and MoneyGram are migrating to stablecoin rails. MasterCard has 87 partners building on blockchain infrastructure. The stablecoin market processes more transaction volume than Visa and MasterCard combined. And the man who made $1 billion shorting the British pound in a single day is on final warning record, saying this technology will run global payments within 15 years. You can dismiss that. You can go back to watching the noise, or you can pay attention. The first rule of compounding is never interrupted unnecessarily. The second rule is, when the cycle turns, it turns fast. This cycle is turning. Most people haven't noticed yet. That is your window. Don't waste it. If this opened your eyes to something you hadn't seen before, hit the like button right now. It takes 1 second, and it helps this kind of serious research-backed content reach the people who actually need it. Subscribe if you want the kind of macro analysis that doesn't talk down to you, doesn't give you hype, and doesn't waste your time. And if you know someone who still thinks their savings account is a safe harbor, share this video with them. not to scare them, but because the people who understand where the world is going will be in a completely different position than the people who don't. See you in the next one.